I often tell people that I got my undergraduate degree in the financial services industry when I first started working with Philip, but that my master's degree came when I worked as a internal wholesaler for an investment management company covering their mutual funds. And the reason why was that I dealt with 20 to 30 different incoming calls per day on different financial planning scenarios. And if I didn't know the answer, I had 3 advanced markets professionals sitting 10 feet away from me, and you could always get them on the phone and then listen to their answer. And so in the 2.5 years that I did that job, I had the opportunity to listen to an accountant, a lawyer, and a CFP talk about advanced planning topics 5 to 10 times a day. On the life insurance realm, I hadn't really known all that much. I really started out in the investment side of the business. And so this life insurance was where I really gained a tremendous amount of education in that time period. And there are 2 standout stories that I have from that time. One of them I mention in the conversation that we have today. The second was a call that came in from a financial advisor, and he was working through the buy-sell agreement that he had set up for a client and the client's father. So we're going through buy-sell agreement, and I had talked about buy-sells and heard about buy-sells a little bit at that point, but I wasn't by any means an expert. And we're going through the process, and something just isn't sitting right with me. I can't quite put my finger on it. And eventually I come to realize that what is wrong is that the financial advisor, so that the situation was the son had bought a hardware business from the dad, and they had put in place this buy-sell agreement in case the son died, that they could pay off the dad for the business. And the problem was that the advisor made the wife the beneficiary of the life insurance. Yeah. And now his thought process was, well, then the wife can then give the money to the dad for the business. I was getting caught up in the tax implications of that, right? And I couldn't figure out that. So I bring on our life insurance expert, and he's like, well, the reason why you're getting caught up in that, Dan, is that the dad is supposed to be the beneficiary of the life insurance. And it ended up that the wife walked away with the business and the life insurance money, and the dad got nothing. And that was brought even into more acute of a horror story when it turns out that the financial advisor was the brother of the client, the gentleman that died, and the dad was also his dad. And so one of those examples as well that I always say, when the chips are down, I don't care if you're family. When there's money on the table, you have no idea what people are going to do. And what ended up happening was the wife took the money and the business and walked away and left the dad with nothing. So that story leads us into episode 28 of the Valuability Podcast, the critical value of life insurance and the critical value of having a life insurance expert in your corner if you are not one yourself. So The Valuability Podcast is for financial professionals, business owners, and anyone interested in financial planning, business, leadership, and personal development. We believe that financial success comes from building a plan on the foundation of your values, and building your ability will help you get there. My name is Danforth Philippe. I was a financial advisor and product wholesaler for over 20 years. My co-host, friend, and mentor, Philip Simonson, joins me each week. Philip was in the financial services industry for over 40 years as a financial advisor, field leader, sales trainer, and was a senior manager covering areas such as advisor development and field operations. So, Philip, we had to make the hard call to call off our fall pheasant hunting trip to North Dakota for only the second time in the history of our annual trips, which started, I think, 1999. Is that right?
I would think so. 99, 98, 99. Mm-hmm.
Yeah, we went a couple of years before I moved to California. And then when I got back from California, we resumed in 2003. And in that whole time, we've only missed, now this will be our second year. And do you remember the first time we missed was related to adding the roof to your now home, then your cabin.
Oh, I had snow in the damn kitchen.
Yeah. So
I was shoveling out snow.
Let the listeners know, at the time I was wholesaling, and I was in.
Yeah, you were stranded.
Yeah, I was in Minot. I had flown out there, and Philip was going to drive out and pick me up. And I get this call on Wednesday night that says, Dan, if I leave to go hunting, I will come back and not have a wife. Said, well, all right, I will find my way home. So, but I don't know if it's karma of you having trouble with your roof now is interfering karmically with our pheasant hunting.
Isn't that coincidental? What do they? Some people say coincidence is a fancy word for God. Well,
right,
right. It's amazing. That's funny, and as many of the listeners know, I always joke. I live in a place where the men are strong, but the women are stronger. But I've also come to learn I live in a place where the men know a lot, but the women know better.
Absolutely.
Right. And it was best I stayed home, and it did work out.
Right. Well, and on a serious note, both myself and Philip's youngest son have medical issues that would make going on a group trip during the pandemic problematic at best, and at worst would be dangerous and reckless. So we have made the decision to call it off for this year, but we will be back at it next year with if all medical issues are resolved.
They will be, and those roosters better be careful.
That's right. They get a year off from being tickled by our near misses.
Yes.
Scared by our dogs and tickled by our birdshot. Well, wherever you find your podcasts, you should be able to find the Valuability Podcast, Apple Podcasts, Spotify, Stitcher, TuneIn. We also have a YouTube channel. Search Value-Ability on YouTube to find us there. You can also find us, of course, on our own website, value-ability.com. Click on the Episodes tab, and our episode player is there. Wherever you find us, please like, review, subscribe, and share. If you would like to get in touch with us, you can reach us at info@value-ability.com. Again, that's info@value-ability.com. Or if you would like to connect with us on social media, go to our website, value-ability.com, and click on the Contact Us tab, and all of our social media links are there. So we will jump into our conversation with our good friend Rod Crandall on the critical value of life insurance as going to be our format going forward. This is part one of our conversation, and next week, be sure to check back for part two of this conversation. So with that, we will jump into that conversation. fantastic, and we are very happy to be joined by a longtime friend and coworker of both of ours, Rod Crandall. Rod Crandall works with USAdvisors Insurance and is one of our go-to experts in the realm of insurance. And so we wanted to have him on this week and next week. It's going to be a two-part series to discuss insurance and kind of from the beginning to the end. So, Philip, why don't you start out and introduce Rod and get the conversation going?
Sure. I'm excited for today's podcast. I've known Rod personally, probably, Rod, we go back to the late 90s and early 2000s. And then we reconnected here probably 2013 and started working very, very closely for the last 7 years. And Rod is the consummate professional and expert in the area of risk management. And we'll have him. I just want to tee this up a little bit that this first part one of this series is going to be, we'll just talk about it as life insurance, the great national conundrum, go over some of the basics. When should you buy? And then the second part of the series, and a little bit also, I should say, about the products. And then the second part is, well, if you don't have a high readiness level to actually introduce insurance and how that can work in the area of financial planning, work with your clients, we're going to we're going to ask him how he what's a coaching relationship look like with Rod, and how you can best select a good coach, and what are the benefits and opportunities by working with a coach. So that's it. And Rod, I just want to kick it off by saying welcome, and also Rod, I believe so highly in Rod. Rod also is done planning around the area of insurance with our three boys, and they're all late 20s and early 30s, and we just teed up that insurance for them because they're starting to have families, and until you are able to build a living estate, you've got to protect yourself, put up that umbrella of time, which is really, unless you till you have enough time and expertise or hire a good competent advisor and be self-disciplined, you'll never, in my opinion, build a living estate that could, where if anything then does to happen to you, you're self-insured. Meantime, you better give that risk to someone else. So Rod, welcome. Is my thought process right there, partner? Or what do you think about what is the purpose of life insurance in your viewpoint?
Yeah, thank you, gentlemen, for having me. Really appreciate it. Yeah, I think you're right on. My opinion is that insurance is really just one more vehicle, a tool in the toolbox, if you will, to really help make sure that our clients' goals are met in all circumstances. And so, more often than not, insurance is really a funding vehicle for those future goals.
Mm-hmm.
To your point, if we live a long time and we make good decisions and our investments perform well and inflation keeps at bay, we can execute our goals without insurance. But it comes to that little question, which is what if? And if
Right.
we're going to do proper plans for our clients, I think we do need to address those what ifs. And the big three are: what if you die early? What if
Mm-hmm.
you become disabled? Or what if you need some form of long-term care?
Yeah, excellent. And so, and that's all about one of the key roles of a I would say, a trustworthy advisor, or the excellent advisor out there, is to help our clients plan for that certainty of uncertainty. And one aspect of that is we all can be certain we're going to die. We just don't know when. So let's take life insurance. And I think life insurance is just the name itself, you really can't insure life. When life is it's done, it's done. I think of it as, it's death insurance, and I don't look at that as a negative aspect. But when should someone, if I'm in my 20s, am I, or early 30s, um, Rod, what should they be looking at? What type of insurance and how much should they purchase? Let's stay with that one for right now.
Sure. So much like your boys that you referred me to, much like those in their 20s and 30s and even 40s, They're generally in accumulation phase, and they really generally need life insurance to really be the present value of the future income stream that would be lost if death
Mm-hmm.
occurred, right? So I tell people it's not about needing life insurance, it's about needing an income.
Right.
And what life insurance does is it pushes money into the investment account at the time you need it most on an income tax-free basis. But it's really about converting that into an income stream generally. So it's really protecting the money machine.
Right.
I ask clients to visualize their income in an ATM machine in their garage, and it's just throwing off that money every single month. And the question is, would you insure that machine? And the answer is most certainly I would. And I think that's what we're really getting at is many people, if not most, in their 20s and 30s, their biggest asset is their future ability to earn an income. And if that goes away, it's going to be very difficult to execute the goals in the financial plan.
Yeah. So I'm, as a lot of our audience knows and listeners, I've been around the sun now. It's going to be 63 times come this October. I got to say, I'm a good yardstick or testimonial to the test of time, and just using, as you said, Rod, life insurance is to continuously fund those goals that you have, like like the three boys, their education, particularly if something happened to me. Um, and I look at it also as kind of that umbrella of time. So until I build up that, where I think I can be self-insured, and we're going to talk more about with long-term care, those goals now, they've been met. I was able to pay for them along the way. But, I started off with the term insurance, and then I also got uh, some variable universal life. Rod, can you tell us and walk our audience through a little bit about when would you use term insurance? When would you use whole life? When would you use this universal life? And what are some of the components that as a consumer you should be thinking about?
That's great. I mean, I'll preface my comments with the idea that the correct answer to every financial planning question is it depends.
Always.
But in,
It is a social science. You are absolutely right.
but in that vein and where you're leading to, let's go back to that 20 or 30-year-old that is building a family, trying to protect their money machine and engaging with a financial advisor. So first and foremost, the most important thing is to make sure we have enough coverage, right? A quick rule of thumb is $1 million will create a $40,000 after-tax income. It's a quick rule of thumb. So if we're going to replace $80,000 of income, we need $2 million of insurance. So then your question is, well, what kind of insurance should we have?
Right.
Well, first of all, most, if not all of that is likely going to be term insurance because we have competing goals and we're funding 529 plans and other things. And by the way, if death occurs, nobody really cares what kind of policy exists. They care what amount gets pushed into the investment account. So term insurance is very appropriate. Now, as you know, the majority of our clients actually have both term insurance and some form of permanent insurance. And that could be whole life insurance,
Mm-hmm.
it could be variable universal life, it could be indexed universal life. In my opinion, how we utilize that is really to set up that supplemental retirement income bucket that our best clients may not have. So, what I mean is, many clients aren't funding their 401ks, as you know, and many clients are eligible for Roth IRAs and aren't funding those either. Well, our best clients either don't qualify for Roth IRAs or are already fully funding them and funding their qualified plan. And for those clients, considering an overfunded insurance policy for supplemental retirement income might make a lot of sense. So if I have a 30-year-old couple and they gave me perhaps a $12,000 budget for their insurance, and they both need $2 million of insurance, we might be placing, $1.8 million in term insurance for both of them, and maybe a companion policy for 200,000 stuffed with as much cash as we can to convert that into supplemental retirement income that we can access on a tax favored basis. Does that make sense?
Yeah, very good. Very good. And if you're thinking about the premium, the way I always looked at the premium, Rod, it really consists of three key components. I call it, I would used to, there's this C, T, and, you know, the L, and the C is, as you described, the premium so much is going for cash. Then T is, that's the term insurance as you described, or the mortality expense table, in which, as we age, and that's the reason why to buy it. I've always felt when you're younger, because insurance is cheaper at that time, and versus trying to buy $1 million worth of death benefit at 50, it's going to be quite pricey, because you're higher, the probability of you dying has increased a great deal. And then the L, I always look at it, that's the load, and I don't use that, but there's commissions, that have to be paid out here. So um, I always like that, to look at it that way and educate my clients that, that think about their premiums that way. And then at the beginning, as you said, if you have extra discretionary income, you can think about some of those policies you just described there for the supplementing retirement income. But when would you use? How about disability? People don't like to touch disability. It's always been a hard one. I felt to position with clients, and what would you say to our clients around those who have the cafeteria style plans? I know there's a good tip there with paying with after tax or pre-tax. Can you elaborate on those two pieces?
So I believe disability insurance is really, again, protecting that money machine that we're describing. And it's more important than life insurance, all things being equal, because the likelihood of us becoming disabled is higher than dying during our working life. And
Mm-hmm.
more importantly, without being rude, it's more expensive to become disabled than it is to die for your family as well.
And that statistic is something like 1 out of 5, right? Or 1 out of 4 people.
Will have some sort of disability, yes. I don't know that they'll have a long-term disability, but certainly short-term.
Right.
Yeah, so I would say it's as crucial as anything. I can also tell you that it isn't placed as much as it should be, even in my practice. Um, Part of that is that it is more expensive because the likelihood that you'll need it goes up. And to your point about the group plan or the cafeteria type plan, there's probably two or three things you really need to pay attention to. And you kind of alluded to the idea of taxability. I can't give tax advice, but the reality is that if your employer pays for your long-term disability benefit and you go on claim, it's taxable to you as ordinary income. And to the extent that you pay for your own coverage and you go on claim, then that is tax free to you. And that can be dramatic, especially for our more successful clients. So let's take an example of maybe a sales rep who earns $200,000 a year, but has a $40,000 base salary. Very often, the standard disability plan would offer 60% of his base salary.
Right.
So 60% of 40,000 would be 24,000 a year, but it would be taxable to him because his employer pays for that. So now all of a sudden he's only got maybe $1,500 a month of disability benefit
After taxes.
after taxes. But he earns 200,000. So we could wrap around a supplemental individually owned policy to sort of bridge that gap. And then that could be created on a tax-free basis. Now, you didn't ask, but when you're presenting disability insurance and really any sort of insurance, I find it very valuable to reference it as a percentage of income. Anytime you're asking for a premium dollar amount, I believe it's effectively too much. $1,000, that's a lot. $10,000, that's a lot. $80,000, that's a lot. So, relative to disability insurance, I would say to that hypothetical individual, you have two choices. You can keep your $200,000 of income and keep your risk for becoming disabled, and your benefit after tax might be $1,500 a month. Or we could take, say, 5% of your income, or maybe 3% of your income at that level. That's probably
Mm-hmm.
more appropriate.
Mm-hmm.
3% of 200 is $6,000
Right.
a year. So would you rather have 200,000 when you're healthy and 1,500 if you become disabled, or would you rather have 194,000 of income and maybe have a monthly benefit of $10,000 a month if you become disabled? So just a little tip there on percentages.
Right. Right. And I always thought of the role of the advisor here. Um, Oftentimes, many of them, what I've experienced in coaching and working with them, is that they avoid the even conversation of insurance, because they don't want to have an egg on their face. It can be complicated, but it is, if you become a student of it, it's fairly simple. And they don't accept it as part of their role perception. Offering introducing the risks that their clients have is, if you're going to be a fiduciary and act as an advisor, you need to cover yourself by having that conversation. And you know, I learned when I was selling insurance, uh, and helping my clients. Look, my role here is to provide you, to demonstrate, to provide you where education and acknowledge where you potentially could have risks. And when I talk about those risks, my role here is going to be, you can either live with the risk, that's do nothing, implement a portion of the risk, that is, hey, I'm going to take 50 percentages, which triggered this, Rod. You can implement 50% of it, 60 or 70%, or you can eliminate all the risk. And that's not, so if anything happens, you're taken care of. You have that peace of mind. Um, and I think, where I was emotionally, any tips to give, particularly our advisors who are listening, uh, the unlimited beliefs, you could call them, to help them get over the emotional roadblocks that they might have about introducing the concept of risk management to their clients?
Yeah, thank you. I do have a lot of thoughts. And, as you know, I've worked inside of over 200 wealth advisors practices as their partner or insurance specialist, sort of carving out and, in my opinion, custom designing insurance solutions inside of the financial plan. And you're right. What I've seen a lot anecdotally through that is a discomfort in bringing up a situation, primarily because we don't want egg on our face. And to your point, it's not that it's rocket science, it's that where is our focus on a day-to-day basis. So as biased as it is, one thing that you can do is put someone like me on your team
Mm.
who is aware of how to do that and feels very comfortable. And by the way, has my own team, because what's interesting about insurance, and I know we see it on the investment side too, is once you really get an understand of the marketplace and the companies and the products that are sort of what I consider to be best in breed, the moment you have that, then they all change on you because something gets changed or introduced, and so it becomes problematic. What I coach on, and to your point about some tips, we need to stop talking about insurance. Okay. Now, I'm not trying to be funny and I'm not trying to hide from the fact that it's insurance. And we need to focus on the outcomes and the goals. And if we're focused on the outcomes and the goals, then we have to consider, okay, we need to consider what could keep us from reaching our goals. And if we can have a good conversation and consider that, then all we need to do is educate those clients on what their
Mhm.
options are, which you alluded to. Okay, it's not really that complicated if you think about it simply. We either have to ask, do I have a risk? And if the client doesn't believe we have a risk, there's no conversation to be had. But if the client thinks that there's a risk, then it's about trying to quantify risk. You talk about defining current reality. Well, that
Right.
exists. Well, how big is the risk? Okay. Then we have to educate on what does it cost and in what designs can we transfer part or all of that risk? And if we conduct that conversation of just considering what this means and educating on our options, there's no selling to be had. The client just determines, yeah, I'm comfortable keeping that risk. Or, yeah, you know what, I'm not too comfortable, but I don't want to pay those insurance premiums. And then I go, well, you're smart. Nobody does. That's great. But that's not what we're talking about. And if we can have that kind of conversation, then we shift. And the last tip I would give there is the advisor has to be comfortable saying something like, I know enough to be dangerous here, but it's not where I put all of my time. So I've partnered or I have a team so that they can have permission when when the client asks something and they go, you know what, I'm not sure about that. Let me check. So I believe you have to set up the fact that we know enough, but depending what we uncover, we may include other people on my team.
Yeah, that's a great point, because I always looked at this as an advisor. You're the generalist. You're the GP, if an analogy to a doctor. And sometimes, as the good doctor, and I'm thankful for mine, Pete. I see him annually. He spots things that, hey, you know what? I'm not the expert in this, but I need to send you over to someone. Same thing here. I think it's very, very uh, sound, practical suggestion you have there, Rod, of making sure if our advisors are out there listening, that they team up with someone that who's competent in this area, and they can use it as going to the teaching hospital. Then we'll talk more about that later. And I think I see Dan would like to add a little something here.
Yeah, I just wanted to jump in and point out that, I mean, essentially what Rod's suggesting is exactly what we talk about every week, which is linking back to the client's goals and values, right? Like,
Right.
stop having conversations about. Just on Twitter the other day, it was a conversation that I saw, and we'll talk about this in a future episode. But it was about not diversifying away from owning 80% of your wealth in company stock, and nowhere in this 30 tweet string did anyone talk about going back to the person's values and goals and saying, okay, it's totally fine to leave 80% of your wealth in one investment. These are the goals you're risking if you do that. Advisors have the capability to have this conversation, and they do it every day. They just do it about investment products instead of insurance products. And so they can have exactly that same conversation. It was the way that I would always set it up is, hey, look, for you as the client, this is a zero-sum game. Either you're going to die and the insurance will either be there or not. There are a limited number of outcomes for you. I have 100 or 150 or 200 clients. For me, it is a certainty that someone is going to die while they're working. Mm-hmm. And I can't afford to not mention it to you and say, hey, look, if you choose not to insure this risk, these are the goals that I'm going to have to chop off once you're gone, and we're going to have to restructure. And again, that's totally fine, but you need to understand how those decisions will impact your goals. And that's essentially, if I'm not mistaken, Rod, kind of the route that you take, which is not, let's stop talking about the product and go back to talking about the plan and how this fits into the plan and what those risks can do to the plan and the different ways that we can manage them.
I completely agree. And that's right on what I believe that we're, quote, selling to the advisor class, right? Most of our competitors are selling product. And my opinion is product is largely irrelevant because at the end of the day, product exists and it will always exist. But the insurance industry is largely leading with product, and it should be the very last thing. Okay, the product is which funding vehicle will fund the goals. And insurance isn't about what that insurance is, it's what that insurance does, right? And the perfect example about that is long-term care insurance. Okay, so the average insurance person or even advisor, in my opinion, has this kind of conversation with their client about long-term care insurance. You know what? We really need to think about long-term care insurance. That could really blow up your plan. And the client says, oh, okay. And then they go reach out and get quotes. And then they put those quotes in front of the clients, and the quotes are $3,000, $4,000, $8,000, $14,000. And the clients go, whoa, that's a lot. And the advisor goes, yeah, it is. And the client goes, I'd like to think about it. And the advisor says, great, you should think about it. And then nothing happens. I'm not trying to be rude at all. I am trying to be direct. And I'm trying to compare the kind of conversation I want to have with that client. So the first conversation I have with that client is, you don't need long-term care insurance. You may not want to buy it. Okay. What I'd like to do is talk about retirement portfolio protection. I'm not trying to be funny, and I'm not trying to hide from the fact that it could be funded with long-term care insurance. But what I'd like to ask you is, what is the impact on your financial plan if you have to double dip because one of you needs care for long-term care? What is the impact, and how do you feel about that, right? And would you like to learn some options on how to minimize that risk or transfer some of that risk? Then, by the way, I'm going to pull together quotes and I'm going to show it, but I'm going to have context. And when I show the quotes, I'm going to effectively say, you have two options here, just like I indicated, because you don't need to put this in place if you don't want to or see value in it. But you have two options. You can keep your $100,000 income in retirement based on this plan, or we can take 95,000 and reposition the other 5,000. So which plan would you rather have? And now we're into a process where we have to really think about what that looks like instead of just, in my opinion, summarily dismissing the insurance conversation because it's insurance and I don't want it. I'm certainly not going to need it and it's too expensive. Oh, I heard commissions were really large too.
I love the number anchoring that you do with that, which goes right up our alley of talking about behavioral finance, which is instead of talking about a $5,000 premium, you're talking about a $100,000 income being reduced to 95 to protect that whole $100,000 income in the future. So you're anchoring it to another number. And obviously that's what the human mind does. Oh, 5,000 is a big number. Well, but 95 is not that much less than 100. And hey, everyone thinks that that kind of thing is, it's a sales trick, or it's not. It's not. It's just the way the human mind works. Is that $5,000 in a vacuum is just a number without anchoring it to that's that I get into this all the time with people. Oh, the Dow was up 500 points today, or the biggest point drop in the history of the Dow. And I'm like, right, but it's like the 60th percentage drop because the Dow is so much bigger than it used to be. Like, it's all about reference. The number doesn't mean anything in a vacuum when you're talking about what does $5,000 mean. If that's a $200,000 income or a $100,000 income means very different things.
And I also think, going back to what you said earlier, Dan, not just the anchoring of the, and how the brain or mind works here with the percentages there and the numbers. It's linking to the values and having that value conversation with your clients and finding out values are internal to an individual and it's what's really important to them. And your top 15 values do not change over your lifetime, uh, but the priority of them will. So if you find out what their top 5 values are, and if one of them is family, boy, there's a big gap here. And Rod, you said it. One of the first jobs of an advisor or anyone is to find current reality. Look, you say you want to be here, but the reality is you're here. And that here is 2 inches below the bar where you want to be if you have it written out on a piece of paper. And the difference in between is pain and growth. But your role as that advisor, though, is to describe to them, look, if family is important to you, here's one of the risks that you are running, and in explaining that and aligning the values then to their goals. And it could be too, some people want to leave a legacy and feel that is their obligation. It could be to their family or it could be to a foundation. But again, I think the power here is if you take their values and then you line up with the goals, as you said, Rod, and Dan's, your support of it is, it's just, the products are the funding vehicles. And if many of our listeners are independent, so as an independent, you can go out and buy the creme de la creme for your clients.
Yeah, so this is probably a good spot to pause the conversation for this week. Rod, did you have any final thoughts before we wrap up for this week?
No, I don't think so. I think that the real key, I guess one last thing I would, is that if you're going to have these kind of conversations, we have to steward some emotions. We've got to ask clients how they feel about things. And it's anecdotal, but many of the advisors I work with, not to put them in a box, but they're numbers people and really good at it. Okay. But if we can't ask a client how they feel, then we can't place insurance, in my opinion. So we need to ask them how they feel. And that can be delineated many different ways. But if we don't ask them, we already know they don't like the math. We already do. So what people do is they quote. They go, hey, I showed them quotes. The only way someone takes action when you show quotes is the lowest number on the page. That's the only way. When you ask them how they feel and what's important to them, then they have the right context that they can make this kind of decision.
And I've also found, again, Rod, my personal experience selling and also working with advisors, if you do the financial plan and you cover that aspect of risk management in the planning stage, an example, look, you've developed a goal around education, and then, and you've finished that goal and you know exactly where you're going to send them to college, how much they're going to need to start putting away. However, now over here, if you should die, and you said family was one of your top values, if you should die before your children actually achieve and walk across that stage, you run a risk, and the risk is, there won't be the funding there because that ATM machine will be shut off. So I think if what I found then is, if I take the clients through the financial plan and I work through it and through the questions, not just the feeling questions, but things that they want to be paid off, etc. And if we incorporate Social Security and any, if they have built up a little living estate and what that can earn in regard to interest, they end up owning the goal. And if they take ownership, when they see the death benefit, if they die, and it's a social science, if the plan is only good that day, then the next day if they die, it all could be, it's different. Or if they continue to live, but because of the time value of money, they at that present time, I think they take better ownership of it, and the policies don't lapse as much as well. And that's my 2 cents on that piece. Do the planning. Let them take their own ownership, like you said, and not just the feeling questions, but also find out exactly what they want to have covered at time of death in regard to what they want paid off, etc.
Awesome. Well, we would just want to wrap up for this week and let you know that if you like what you've heard so far and would like to reach out to Rod, find out more about his business and what partnering with him looks like, you can reach him on his cell phone directly at 847-305-0600. Again, that's 847-305-0600, or you can reach him at Crandall, that's Crandall, at USAdvisorsinsurance.com. Again, that's Crandall at USAdvisorsinsurance.com. And we will also put up his contact info on our website, value-ability.com. Click on the episode tab and we will have his contact information there. So for this week, we will pause the conversation here and talk to you next week. And that concludes part 1 of our conversation with Rod Crandall on the critical value of life insurance. Be sure to check back next week for part 2 of that conversation. We will transition into our article review for this week. And this week we're going to cover Just Married, How to Say I Do to Shared Finances. Now, this article discusses different points of the financial process of getting married, taking on a partner. And I'm just going to quickly walk through. There's over 10 of them, but I think for reference, I will go through and list out just the title of each point so people get an idea of the different topic areas that the article covers. Also want to remind you that you can find a link to this article on our website, value-ability.com, under the content tab, or you can find it on our Twitter or Facebook accounts. I always post it there each week as well. So, number 1, have a heart-to-heart about money and marriage. 2, build a budget for your new family. 3, decide how you'll handle shared bills. 4, see how your credit scores stack up. 5, decide how to deal with finances in marriage. 6, start saving for a rainy day together. We like that one. 7, create a plan to conquer debt as a team. 8, set your money goals. 9, help to secure your family's future. That is about future investing. 11, make sure you're saving for retirement. 12, adjust your insurance coverage, very appropriate for this episode. And 13, start estate planning early. So I will jump in and say that, as our consistent listeners will know, I often pick articles for things that bug me, and this is no exception. All of the articles that I read about this topic, while they do mention the fact that you can keep your finances separate, they mention it more as just almost an afterthought of the entire money process of getting married, without pointing out a key factor that I, in fact, didn't know until I was in my mid-30s. I'd been in financial planning for over a decade before I realized this, and is not talked about, which is the legal contract of marriage does not make you financially responsible for your partner. What makes you financially responsible for your partner is entering into financial arrangements with them, co-signing on a loan, buying a house together, making each other beneficiaries of things, so on and so forth. But if you are married and you do not join your finances, you are not responsible for your spouse's financial situation. If they rack up debt, you are not responsible for that. So now the big example of this is a very close friend of Philip and mine, who we won't name because I didn't get clearance for talking about him in public, but good friend of mine, younger than me. I call him my little brother, and at times I often wonder if he's listening to all of the unasked for advice that I give him. But one of the things that first made me pop up and say, oh, wait, he really does listen to me, was the fact that when he got married, they kept their finances separate. And the reason for that was that he wanted to start a business. He started a brewery. It then ran into financial trouble, and as they were trying to sell it, they had some production problems and ended up having to declare bankruptcy. But his wife owned the house. She had all of their main credit accounts. So when he declared bankruptcy, it did not affect their overall financial situation. And the only reason why he was able to do that without wrecking their own personal financial situation was because they did not join their finances. So now I know many people see it from the standpoint of, well, my partner's not going to think that I trust him or her, so on and so forth. But just understand, as many people don't, that there is no legal obligation for you to be financially responsible for someone, even if you're married to them. It is only the arrangements that you enter into outside of the marriage contract. So that was the key that I wanted to talk about from this article. There are a couple other things. Great article overall, though, I thought. Philip, your thoughts?
Yeah, I liked it too, Dan, and brought back memories. It's going on 37 years of marriage. I was going to say blissful, but that would have been a lie.
So at times it's been blissful.
Oh, absolutely. How do I sum up my marriage? I'd say some of it tragic, most of it magic, and I wouldn't have it any other way. And I would also say, what I've learned is you got to ask the question, would I rather be right or would I rather be in a relationship? That's the acid test question.
Is that the reason why I'm single? So well, I'd rather be right.
I don't know, Dan. That's
probably. The answer is probably.
Probably. But going back, just like what you said, Dan, first things first here. One of the things, yes, Lisa and I have done obviously a lot of things right. We've made it 37 years. But one of the first things we did was we went to, oh, it was prior to getting married. We had a weekend retreat, premarital weekend retreat, and they talk about the different, money. And money's one of the key subjects of why people end up getting a divorce. It's one of the big three. So, we set goals, right? So my point to the listeners is I wouldn't wait till the honeymoon. I would have this conversation before I tie the knot. And it's all about setting up boundary work. Lisa and I, we set up some boundaries right away. One was, if I'm dating myself because again we're going back to 1984, but if you spent over $100, you'd have to talk to the other spouse to get clearance on it. So we held that for a while. Then we met, we set up a monthly budget, and we would review the monthly budget once a month, and we'd you know at that time, just have a nice open up a bottle of wine, and we'd go through it, and are we on track, not on track? And that would be, we'd know if we're on track because we'd set annual goals of where we wanted to be financially. One of mine was, by the age of 40, and Lisa's was, I was striving for that financial independence, and was to have 2 commas for a net worth, and did accomplishment. Age 50, we had, I wanted to have, as, well, we wanted to have over a net worth of over 3 million. We acquired that, but I don't share that because it didn't make a great deal of money, but the importance of goal setting. You've heard us say, and having your partner be a part of it. And, because it aligns in your behaviors and your thoughts and your actions. So I just think it's crucial, Dan, and there's good stuff there if people will adhere to it. And it really requires to that, and that adherence comes down to discipline.
You made a great point in our discussion before we started today, which was, a lot of these points, if you haven't had some of these conversations already by the time you become engaged, maybe you're moving a little too fast, right? Like some of these conversations you certainly should have had, maybe not explicitly, maybe not a let's sit down and talk about our debt, individual debt conversation, but by the time you become engaged, you should have at least an idea of what the other person's spending habits are like and what their budgeting habits are like. And so a lot of these are kind of, I think, codifications of prior conversations. But as you say, it's also, it can be touchy, right?
Everyone's coming from a different perspective, and usually it's their parents' perspective. And then you just got to ask yourself, okay, well, do I still need to have that perspective going into this new relationship? Does it
Right.
still hold the water? But again, have that conversation prior to going down that aisle.
Yeah, and I would say probably not many people are like me. Like if I was dating and a woman said, we really need to sit down and talk about our attitudes towards debt and budgeting, I might just propose right there, right? Where have you been all my life?
Oh, I'd have a hard time believing that, Dan.
But that I would be on a date? Yeah, you're right.
Oh, dates, no problem. You're proposing, right? willing to acquiesce that quickly? No.
Well,
No.
Probably not. You're right. Probably not.
But that's all I have on this one.
Yep.
Well, the one last thing is, boy, and you said it, and I'd highlight it, and after you've just got done listening here to Rod, get that insurance right away. Get to, if just starting off, I mean, before you even start saving for retirement and other goals, Get the term insurance. Buy as much of it as you can afford, and while it's still cheap. Because and if you're granted time, and then you'll be able to accomplish these other goals. So,
No, I absolutely agree. I went back and forth on the title for these 2 episodes with Rod and settled on the critical value of life insurance, but the reason was that I kept coming back to something along the lines of life insurance, the essential foundation of every financial plan. And that's just too long for a podcast title, it is the foundation, and it is the base of that pyramid. We've talked about it time and time again, and you just cannot stress it enough that without that life insurance, and there's so many things. Okay, you could walk out in front of a bus, you get a health issue. I have numerous health issues that make it impossible for me to get term life insurance. So you never know what's going to develop that next week, next month, next year. And then the longer you put that off, the more comfortable you get with that risk. That risk doesn't change. It gets slightly smaller because you get older, but the risk stays the same. So I would second Philip's thought and say life insurance is that absolute first step. One other thing I wanted to point out, they make this under the section on make sure you're saving for retirement, but I've talked about this in terms of debt. They call it gamifying, which I kind of like, I kind of don't. Your saving and investing goals, and I talked about this in relation to your debt goals, where when you have these intermediate goals, set a point where you say, and the example in the article is every $5,000 that their balance hit as a newlywed couple in their retirement accounts, that they would go out and have a date night. But just then I talked about it in the past as, when you get a credit account paid off, go out and give yourself that little gift, that celebration of, hey, I got some debt taken care of. But I'd like that with all of your goals. Have these small intermediate goals. And you mentioned it just a few minutes ago, Philip, where, hey, by 40, we wanted to do this. By 50, we wanted to do this. But in between there as well, you can have smaller goals of, hey, we want to, hit this target, or we want to, have our child be able to attend, this elementary school or this high school, whatever your specific goals are, have those as conscious things, and then celebrate the successes, because it reinforces that process overall. So
well said, Dan. Well said. And I just want one last piece for those who are listening. This shouldn't be. I hope it's not coming across as rigid. Look, you're taking the spontaneity out of life by setting these goals and having the monthly budget reviews, etc. What I learned to do, I loved spontaneity like anyone else in adventure, but I looked at it, and I learned to look at it from a different perspective. That then I started, in anticipation, I would start to get excited about, hey, here's what we're going to be able to do because we have achieved the goal. So celebrate is keyword, as you said. Celebrate, celebrate, celebrate. Enjoy life as you're going to. You live for today, but you plan for tomorrow.
Perfect. Well, if you had topics or questions that you would like us to cover in an upcoming episode, reach out to us via email, info@value-ability.com. Again, that's info@value-ability.com. Or you can reach out to us via social media. We've got Twitter, Instagram, Facebook accounts. Go to value-ability.com, click on the Contact Us tab, and all of our social media links are available there. Wherever you find us, please like, review, subscribe, and share. Keep sharing out there. We just noticed today that we have listeners in Finland, in Italy. I think that's probably Elisabetta Basilico's coworkers and family from Italy, but China, Singapore, India. So Of course, the UK, we have always had strong listenership there. So thank you to all of our international listeners. And if you're out there listening to us and enjoy our content, please pass it on to someone else who you think might like what we are doing. Next episode, of course, episode 29, The Critical Value of Life Insurance, Part 2. Be sure to check in with us to get the second part of our conversation with Rod Crandall. Reach out to us and tell us how you build life insurance into your specific financial plan, or if you're a financial professional, how you build it into your practice. Do you use an outside insurance advisor? Do you do it on your own? What are the steps that you take within your practice to build life insurance into it for your clients? As always, thank you for listening. Be sure to join us next week. And remember that financial success comes from building a plan on the foundation of your values, and building your ability will help you get there.
This is a podcast collaboration, not a peer-reviewed journal or a sponsored publication. We make no representations as to accuracy, completeness, correctness, suitability, or validity of any information in this podcast, and will not be liable for any errors, omissions, or delays in this information, or any losses, injuries, or damages arising from its display or use. All information is provided on an as-is basis. It is the listener's responsibility to verify their own facts. You should be aware of the real risk of loss in following any strategy or investment discussed on this podcast. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this podcast may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as recommendations appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this podcast. Before acting on information on this podcast, you should consider whether it is suitable for your particular circumstances, and strongly consider seeking advice from your own financial or investment advisor. The views and opinions expressed on this podcast are those of the authors and do not necessarily reflect the official policy or position of any other agency, organization, employer, or company. Assumptions are not reflective of the position of any entity other than the authors, and since we are critically thinking human beings, these views are always subject to change, revision, and rethinking at any time. Please do not hold us to them in perpetuity.